This Thursday brings the latest Bank of England interest rate decision. Many within the UK will be hoping for a rate cut. It doesn't look forthcoming, unfortunately. Nonetheless, it's going to be an interesting meeting with a focus on QT, but also coming in a week that sees a host of major data points, most notably the inflation gauge. So let's try and gauge exactly where we go in terms of UK rates and what the impact of this meeting could be for the likes of the FTSE 100 and for the pound. So first of all, let's look at things from a wider perspective. You can see here, excuse me, you can see here that global rates have, of course, been on a downward trajectory, but some have been cut at a faster clip than others. And certainly the UK finds itself around the top end of this chart. Most notably, really, you can see the US expected to cut rates this week. Well, they haven't cut rates in 2025 at all. The UK has, and we've seen the Bank of England cut rates last time around, but there's a skepticism over the ability to continue on that downward trajectory, in part owing to elevated inflation levels. So you can see here it stands in stark contrast to the likes of the ECB in particular, of course the SNB, but that's a different story. But many of these central banks have their interest rates well below where the UK stands currently. In terms of UK inflation, this is the big hindrance really when it comes to the ability to step in. Certainly the government would like to be more expansive with their spending, but instead they're going to have to raise taxes. But unfortunately, it's the actions of the government that have had a pretty major impact when it comes to inflation levels and the ability of the Bank of England to actually step in. And that's because it was in no small part due to the policies of the Labour government that we saw that massive 1.2% inflation metric for the month of April. And in actual fact, whilst we do talk about the UK having an inflation problem, and you can see on the top, 3.8 for both core and headline CPI, the fact of the matter is that inflation since April has been under control. And you look prior to April, by and large, it was relatively under control then as well. I mean, the standout problem that we have here is that 1.2 figure. So it might be the case of having to wait all the way until April to see that drop out for inflation to look a little bit more hunky-dory. For the time being, it does not look that at all. The highest inflation level of any G7 nation. And that, of course, is a concern for the likes of the Bank of England. Now, notably, like I said, the last 3 months, we've seen it drop off pretty significantly. And you can see that on the bottom section there, we've got the 3-month annualized figure for core and headline, both of which are below 3%. Notably, the headline inflation, 2.26, is the current pace of inflation according to the last 3 readings. So, notably, I'm recording this after the jobs report, but before the inflation report. So the inflation figures on Wednesday will be very important in terms of gauging exactly the direction of travel for rates in the UK. And certainly I would say that there is a feeling right now of uncertainty and a lack of real conviction over exactly where rates are going to go in the UK. Now, in terms of the economy itself, there's a lot out there at the moment about the state that the UK economy is in. I don't necessarily think it's as bad as many would have you believe, but certainly where you've got the picture of many people leaving the country, the government hiking taxes, people feeling like they're not really getting much for their money in this country. Nonetheless, by and large, the services sectors continue to strengthen. You can see here 54.2 on the services PMI, 53 for the composites, the manufacturing sector that has been suffering. Thankfully, the UK's got a nice deal in comparison to many of the other nations around the world with the US. And that US-UK relationship comes into stark focus this week with Donald Trump coming over for a second state visit. Rather unprecedented for a second stint in the White House. But nonetheless, old King Charles doing what he can to butter up the president in the US. So there should be some good news coming out this week in terms of announcements between businesses in the UK and the US. In terms of the jobs market, like I said, we have seen the latest jobs report in the UK. We have been seeing upward an upward trajectory in terms of UK unemployment. You can see that in the bottom section here, the blue line. It was flat this time around, but certainly the pathway is higher. I would say being in the mid fours is not necessarily a massive problem right now, right? We don't run at like 6%, 7%, 8% unemployment, but the trajectory is no doubt towards the upside at the moment. In terms of the latest claimant count figure, we saw a rise in terms of claimants. That's not necessarily ideal, but it comes off the back of a sharp decline last time around. And if you look at it in comparison to years gone by, it doesn't necessarily tell a story of like massive economic suffering that would point in the direction of the central bank needing to step in drastically this time around. But part of the reason why they might need to step in, or they do need to step in, is that it's difficult to really overstate the problems created where you have elevated interest rates, and that ultimately leads to elevated borrowing costs across the spectrum, but most notably on the long end. You can see here with the 30-year continuing to climb, a divergence between that and the shorter term, 1 year. So you're seeing that longer outlook really starting to sour, people demanding more to be able to take on UK debt. That, of course, is a problem for the government. And it comes in stark focus this time around because there's a big focus on QT as well. Notably, when you look at the outlook from Capital Economics, they do have a projection that points towards a decline in terms of rates next year. By and large, there's a lot of uncertainty over this, right? Because we don't necessarily know if we're going to see a resurgence in terms of price pressures and a continuation of this upward move. But like I showed you, it could be the case that once that April figure stripped out, all of a sudden we're back in a pretty good position. And the closer we get to that, the Bank of England starts thinking, well, we can look beyond the current month and say we can act ahead of time. That would form the basis of the view that next year sees significant rate cuts coming into play. But for the time being, it looks unlikely we're going to do that. Now, QT is going to be a major theme and narrative for this meeting. It's an annual review of their policy. They currently have 100 billion running off. And the idea this time around is that most likely we'll see that reduced. You can see that the pace of the reduction of the balance sheet, which of course follows that massive building up of the balance sheet over the course of the pandemic, the rolling off of those securities has been at a relatively rapid clip. So it might be time to slow that, and in which case you're talking about potentially putting some downward pressure on borrowing costs and helping things out in terms of the yield perspective. Now, what's notable here is that we've essentially got coming from a position where we've been seeing significant sort of rolling off of maturities, not too many active sales, to a position where when we're having to embark upon QT, it's more a case of actively selling rather than just simply letting some roll to maturities and then not necessarily renewing them. That makes it a bit more problematic anyway, and in which case it does stand to reason that they take a slower pace this time around. You can see that the expectation is that we will see that over the course of coming years. And so certainly this is something for us to be following over the course of this meeting, quite exactly what the outlook is in terms of QT and the pace of quantitative tightening remains to be seen. But certainly there's many that are out there and saying the sheer amount of borrowing taking place over the near term with debt ramping up, central banks potentially having to step in because the demand just isn't there when it comes to your normal sources of demand. Many are not necessarily grabbing those treasuries in the way that they have in the past. And in part, that's why we're seeing the likes of gold appreciating the way that it has, because people are looking for haven assets, and treasuries aren't necessarily doing that role in the way that it has in the past, or certainly perceived to be. So we're seeing a lack of demand and certainly significant supply as debt ramps up. So they need to potentially issue more. So in terms of the expectations for this meeting, the view is that we see no change, 97.5% expectation this time around. Then no change in November, so 87% chance of that. Then no change in December, 65.6% expectation of that. So you can see there's a small growth in terms of expectations of a move, which is certainly not there at the moment. And then you look further out into next year, there is a chance of a rate cut, but markets are just not convinced as it stands. And that's why this meeting and the forthcoming meetings are really going to be key. And the inflation data are really going to be key when it comes to setting out the stall in terms of exactly what the pace of easing is going to look like. Now, in terms of some of the key charts, let's just look first and foremost at the FTSE 100, starting to roll over a little bit at the moment. The wider trend here on the weekly time frame shows you exactly what we're dealing with. So very clearly a bullish trend here. Now, if we were to look at some key levels, you'd certainly be saying, look, if we start breaking back below these kind of levels, your 9101, 9027, then it starts looking like we're going to start giving back some of those gains. Until that happens, yes, we're pulling back at the moment. It's a potential retracement. But the caveat here is we haven't broken the previous high here. So that's a bit of a warning sign, really, that we could potentially break through support. So I guess you could say we're consolidating at the moment. We're not necessarily saying that we've completely topped out by any stretch of the imagination. But on the intraday basis, you can say failed to break through that prior high. Now breaking through your initial swing low, which is 92.16. So it points towards near-term potential retracement into here, but from a wider perspective, a breakthrough the likes of 9101 starts signalling the possibility of a wider pullback for the FTSE 100. Then we've got Euro Sterling from a wider perspective. Looks a bit ugly there. There we go. From a wider perspective, here's the weekly time frame. So you can see long-term don't really go very far, but you can see certainly on the bottom end that price action sort of comes into this zone and starts to sort of turn upwards. And then you've got the sort of range up to there. I guess you could point towards this kind of area. But there's plenty of space towards the upside if we were to figure in that direction. And certainly considering the fact that the ECB are pretty much done with their easing, then you've got the UK, once inflation starts to roll over in a meaningful manner, we get closer to those rate cuts. I think there's a good chance that we do see this pair really picking up in a meaningful manner. That might not be quite yet, but certainly at the moment, you can see here we've rallied. We've come into a retracement. It's not been a big retracement. Then we've gone ABC style retracement. Now we're seeing the creation of higher highs, higher lows. The pullback into the 76.4 once again, as you can see on the 4-hour chart, to me points towards the possibility of another move towards the upside. So a breakthrough 0.866 would signal a possibility of another leg higher here for Euro Sterling. And in particular, if this meeting portrays a Bank of England that's ready to act if need be, and in particular, if inflation comes in low on Wednesday, that could feed into that narrative as well. Bear in mind, though, I think that is going to play out over the wider time frame. I just don't necessarily know how long it's going to take to play out because we need inflation to get under control and the Bank of England to move in that direction. But the Bank of England will want to cut rates. They just need to be facilitated by the data. That's it for today. Make sure to like, subscribe, and follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.